I'm Jessica Mitton for IB Times TV, and joining me today is James Gellert of Rapid Ratings. Now, it's so great having you with us today.
Thank you, Jessica. Good to be here.
Twitter announced their first ever quarterly earnings report, which was highly anticipated after their IPO in November. Now, they beat on earnings, but when you look at those average monthly active users, 241 million, but that was less than people were expecting. What was Rapid's assessment of their earnings report?
Well, we look at 62 different measures within a company's financial statements to get our financial health rating. Our financial health rating is a 0 to 100 score. So we're looking at a very wide variety of things. No individual measure disproportionately drives the ultimate rating. It's really about how all of these different elements of the company interplay to generate our financial health rating score. We happen to have them rated quite low. They're rated a 16 on our 100-point scale. That's actually 2 points under where they came out at the IPO. But when you're at that level, you're in our very high-risk zone, and investors and anyone else who's looking at the company as a counterparty should be very careful. In their case, it's a very early-stage company. There's a lot to prove to the market, and they came out probably earlier than when other companies like, say, a Facebook did their IPO. So there's a very big difference between them and some of the industry peers that a lot of the market tends to compare them against.
Now, when you have these social media companies reporting earnings like Facebook, LinkedIn, when you do say with Twitter there's fake accounts, fake users, how exactly do you think the company is looking at this? And I'm sure investors are concerned about how that affects mobile ad growth.
Well, look, at the moment, investors are looking at the big picture. How much revenue is it driving? How many new users? And what's the interaction with those new users? Most of the market hasn't really been paying attention to the monetization of those users and how that's driving the company ultimately to profitability, which they need to. Ultimately, every company needs to be profitable. Every company needs to be returning to its shareholders, returning on capital employed, returning on assets, returning on sales. And they have yet to demonstrate that they can do that. It's a long march. They're going to have to get there. But what we found out yesterday is that the market, the momentum behind the market, is really paying close attention to how many new users and can they continue that fast growth. And they've shown that they can't. And the market has punished them quite severely.
When you have a company like Twitter, when this is their first ever earnings report, when is the next most important report?
In one sense, every single report from now on is extremely important because they have to show that they can execute. They have to show that they can deliver. This report I wasn't terribly concerned about because the banks that brought the IPO have a huge vested interest in making sure that the timing was right and that the IPO is successful. So I don't think they would have let Twitter come to the market with the IPO if they thought this first quarter had a lot of risks to it. So I think the timing was probably very well orchestrated, and there weren't a lot of surprises to Twitter or the banks involved in this first one. The next one is going to start getting more interesting and start getting more important. A, because it will be further along the road and further out of the hands of those who controlled the IPO. But B, because we're going to have a lot more shares available to be sold. So the lockup periods for the restricted shares, there are 2 lockup periods coming off, one this month and another in the spring. And when those 2 happen, another 87% of the stock will be available to be sold or bought. And we'll see how much the next earnings report affects the float, the interest, and the buy and sell momentum.
How long do you think a company gets a honeymoon phase for? Is it like you said, maybe the next year when you do see that full year earnings?
Well, I think it's different for different companies, and it depends on how they're doing in the interim, but I think Twitter's honeymoon is over. I think the market now recognizes that more fundamentals need to be observed, and they're not going to get quite the same leave pass that they got coming out of the gates.
And finally, what next do we look for in their earnings? Is it all about that mobile ad growth, or is it more than just that?
I think it's how much closer they're coming to profitability. So that's a combination of how many more users are they bringing and what's the momentum of that growth, how much engagement they're getting with those users, what the mobile ad growth looks like, and how much of that is able to go down towards the bottom line. So are they continuing to spend on employee compensation? Are they continuing to spend on research and development? And if they're doing those things, are those being done in an efficient way that makes the company stronger, ultimately making it be able to return more to its shareholders?